a general question about kind of how you manage the portfolio of the fund. This questioner is asking about when do you decide to sell a stock? So you've got all these excellent, strong compounding businesses that are growing over time into their market caps eventually.
Mm-hmm.
When you decide, first of all, when do you see that happening, that they get to that level where you might start thinking about selling some of these long-term holds? And then when that time comes, do you think you plan to sell covered calls to sell? Will you immediately exit? Will you tranche your way out? How do you manage that
Yeah,
decision about when and how to sell any of these companies?
that's a great question. It's a perfect question. So, our selling discipline is pretty strict. Ideally, by the way, we want to own these Fisher compounders. In an ideal scenario, we never have to sell because that means that the business value is growing, and we're seeing the stock price rise, but the business continues to grow. But of course, we have situations like a Graham type value investment where it becomes full valued. So when we sell is when the equity price is matching our valuation of the business. And so high level, we do use covered calls. We would definitely sell with a call, and we will price those covered calls typically in a matrix where we will have various strike prices, varying premiums, and we will also have different expiration dates. So it becomes like a cost averaging sale over time, and the premiums, and the best way to really do this is an example. So if you think back to the generic $100 stock we referred to, we might have bought that stock or sold a put on that stock and picked it up for $75 after receiving a $25 premium. And maybe we did that because we anticipated that the shares were going to grow to $750. So if the shares quickly rise to $750, and it's a few years have gone by perhaps, when we get to $750, what's amazing is that the call premiums will be quite high. And so because the shares have run up so much. So as the call, if we think the value is 750 and the market price approaching, say, 700, we will start selling covered calls with a strike of 750, going out into the future. And we might pick up, let's say, $100 for that premium. So what we'll ultimately do is we'll be entering in the stock for 75 instead of 100, and we'll be exiting for 850 instead of 750. So basically, when it reaches its full value, or when it reaches a point where it's overrun its value to a level that we don't expect the compounded gains to be very high, then we'll start exiting. Of all the infinite compounders that are on our previous slide, I think the one that has a potential to reach that level would actually be Seritage. So we could find ourselves down the road in a situation where the properties have been redeveloped, the revenue's coming in, they reinstitute a dividend as a REIT, everybody's interested, the price goes up quite a bit, the price could go up quite high, and suddenly we have this $4 billion market cap firm, and it's just brick and mortar real estate. It doesn't, that is something that ultimately we will find an exit. I don't think it's an infinite compounder in quite the same way that some of the other businesses are. And so we are, constantly valuing the businesses, and basically when it reaches its full value, we exit through a covered call.